Welcome to The Explainer. You ever wonder how a startup gets the cash to build its first factory? Or how a giant company like Apple funds the next big thing? Well, the answer lies in something called a company's financial blueprint, or its capital structure. It's basically the master plan for how a company pays for, well, everything. And today, we're going to break it all down. Okay, if you've ever taken an accounting class, you've probably seen this equation a million times, right? Assets equal liabilities plus equity. And at its core, it's pretty simple. Everything a company owns, that's its assets, has to be paid for somehow. And that money only comes from two places. Either you borrow it, which is what you owe, or it's money put in by the owners, which is the equity. It's a perfect balance always. But, that equation is just a snapshot. It doesn't really tell you the strategy behind it. The real question, the one that's worth billions, is how a company decides on its funding mix. How much should they borrow versus how much should come from owners? That decision, that is right at the heart of corporate finance. And the answer to that how is what we call capital structure. It's just the specific recipe, the unique mix of debt and equity that a company uses to fund its operations and its growth. So let's make this real with a simple example. Picture a company with $1,000 in assets. We look at the balance sheet, and it says it's funded with $400 of equity and $600 of liabilities. So the capital structure is 60% debt and 40% equity. Case closed, right? Well, not so fast. The devil, as they say, is in the details. And here's the key thing you've got to understand. Not all debt is created equal. Some of it is just the normal stuff that happens in business every day, like paying your suppliers. But other parts of it are very deliberate long-term financing decisions. Let's break down that $600 in liabilities. You see, a big chunk of it, $400, is what we call operating liabilities. Think of that as money you owe to your suppliers for inventory you just bought. That's not really a strategic financing choice, it's just part of running the business. But that other $200? That's long-term debt. That's a bank loan. That's money the company chose to borrow to fund itself. And that is the piece we care about for capital structure. So this brings us to the golden rule. When we talk about capital structure, we are only looking at the intentional, long-term sources of money. So we totally ignore those operating liabilities. For our little company here, the total capital pool is the $200 of long-term debt plus the $400 of equity. That's it. So company has two main levers it can pull. It can take on debt or it can issue equity. But how in the world do they choose? Well, it's this constant balancing act, this huge trade-off between the good and the bad of each one. On one hand, you've got debt. It's basically a loan. Now, it's risky because you have to make those interest payments no matter what, even if business is terrible. But the big upside? You don't give away any control or ownership of your company. Then you've got equity. That's when you sell a piece of the company itself. It's safer from a cash flow perspective, but it dilutes the original owners. Every time a new share is issued, their slice of the pie gets just a little bit smaller. Okay, so we've got our two main ingredients, debt and equity. But to find the best possible mix, we need a way to measure the total cost of our financial recipe. And that's where this really critical metric comes into play, the weighted average cost of capital, or as everyone calls it, the WACC. The WACC is, for all intents and purposes, the blended price tag on all of a company's money. It averages out the cost of its equity and the cost of its debt, and it weights them based on how much of each it uses. It tells us, on average, what it truly costs the company to fund itself. First things first, we need the weights. Let's stick with our example. Remember, the total capital was that $200 in debt plus the $400 in equity, which gives us a $600 total capital pie. So debt is $200 out of $600. That's 1/3, or about 33%. And equity is $400 out of $600. That's 2/3, or about 67%. See? Simple enough. Those are our weights. Now, I know the WACC formula can look a little intimidating at first, but it's really just putting our recipe together. We've got the value of equity and debt. Those give us our weights. Then we need the cost of each. RE is the return that equity investors demand, and RD is just the interest rate on our debt. And last, you see that T? That's the tax rate. Now, why tax? Because governments give companies a tax break on their interest payments, which actually makes debt a little bit cheaper than it looks on the surface. It's a really key advantage. All right, that's enough theory. Let's get our hands dirty. Let's plug in some actual numbers for our company and calculate its WACC. This is where it all clicks. So to do the math, we just need to make a few assumptions. Let's just say the company's cost of equity, that's the return its shareholders expect to make, is 10%. and the interest rate on its debt is 6%. And finally, it pays a corporate tax rate of 25%. Let's just walk through this. First, the equity piece. We take its weight, that's 67%, and multiply it by its 10% cost. That gives us the weighted cost of equity. Simple. Next up, the debt piece. We take its 33% weight and multiply that by its 6% interest rate. But we have to remember that tax break, so we adjust for it to find the true after-tax cost. And then finally, we just add those two numbers together. And the final result is 8.17%. This one number represents the company's blended cost for every single dollar it has raised. Put it this way, on average, to finance everything it does, this company pays 8.17 cents for every dollar. But so what, right? Why did we do all that math just for one little percentage? Well, because this 8.17% isn't just some number for a spreadsheet. It's one of the most important figures a company has for making huge, real-world decisions. It becomes the company's hurdle rate. So this 8.17% becomes the hurdle rate. Think of it like the minimum passing grade for any new investment. If the managers are thinking about opening a new factory, and their best guess is that it will only earn a 7% return, they should not do it. Why? Because they'd be paying 8.17% for money that's only going to earn them 7%. That's a losing game. That actively destroys the value of the company. So you see, this whole thing is absolutely fundamental. The capital structure decision a company makes sets its cost of money, the WACC. And that WACC, in turn, decides which projects get the green light and which ones don't. It's a chain reaction that directly shapes a company's growth, its risk, and ultimately, its total value. Which brings us to our final and maybe most important question. We've established that the tax shield makes debt cheaper than equity, so why not just finance everything with debt? I mean, why not just borrow as much as humanly possible to drive that WACC down to the absolute minimum? Well, the answer comes down to one simple, powerful word: risk. And finding that perfect balance between cheap money and the terrifying risk of bankruptcy, well, that's the central puzzle that every CEO and CFO has to solve.